Well, thank everyone for attending this afternoon and taking some time out of your day to come visit with us. There's obviously a lot going on in the markets and in the economy these days. Just in the few weeks since we last held a call with clients, a lot has changed, and so we want to cover all the updates. We're going to talk a little bit about what's going on in the economy right now. We're going to see some really ugly numbers for the next few weeks as far as the economy goes. But obviously the market has bounced nicely here over the last 6 weeks. So we're going to talk a little bit about why that happened. We'll look at the government response, what the Federal Reserve has been doing, and then, of course, most importantly to you, we'll talk about what we've been doing in portfolios and how they've rebounded as well. And then we'll do a little bit of peering into the future and see how things might look throughout the rest of 2020. For those of you who don't know me, this is Matt Venker. I'm one of the portfolio managers on the investment team here at FNBO, and I will be discussing all of this with Kurt Spieler, our Chief Investment Officer, who will summarize our thoughts on everything that's going on in the world. So again, if you have any questions, please feel free to send them in through the chat function. If you have your computer or your phone, and you're seeing the slides up on the screen, you should have a little chat box on the right side of your screen, or you might have a little icon on the top right of the screen. Just open up that chat box and feel free to send through a question. It will come just to the panelists, so nobody else will see the question, and then we will filter those questions through and answer those as we can during the call. But feel free to send those questions anytime as you're thinking of them. So with that, let's get started. And Kurt, why don't we start with the big picture and look at where the economy is right now.
Thank you, Matt, and wanted to also reiterate my thanks for your participation today. What we've prepared is 11 slides based on questions that we've been consistently receiving from clients over the last few months. As Matt indicated, this is a guess in terms of what your biggest concerns are. So please use the chat function and or after the call, we'll try to answer your questions as well. First up, kind of starting with the growth of the economy or lack thereof, and specifically the unemployment rate. If you look at it, over the last 6 weeks, 30 million of people have filed for initial unemployment claims, which is a record number. And I'll try to describe these charts as we go through in case you're just participating by phone. But the first chart on the right here, the unemployment rate was hovering below 4%, and is now projected by the Congressional Budget Office, or CBO, over this month as well as next month to exceed or go above 15%. So we're going to get the labor report here on Friday, which will show April or through mid-April, and then it's expected to rise. As you also see from this chart, it's expected to remain fairly high, the unemployment rate, through the end of next year. Turning to the left part of this chart, we have gotten some GDP, gross domestic product data here over the last few weeks. This is the first consumption-led recession. So this is different than prior recessions in that it's focused in, as I think we all know, restaurants, hotels, airlines, leisure, retail, sports are big venue items. So it's focused on there. In the first quarter, GDP shrank by 4.8%, with consumption the biggest issue, and down over 7% in the period. What I think is interesting about this chart is the estimates for Market Watch for the second quarter. So with the government essentially shutting down the economy here in March, and for most of the economy staying closed through April, you're seeing pretty negative estimates. So although states are starting to reopen their economies, it's certainly expected that second quarter will be the trough or the worst period for GDP performance and the biggest contraction that you'll see over the last 30 years.
Now, Kurt, the unemployment rate is kind of scary looking, with the CBO expecting it to be over 10% even at the end of next year. Is that realistic? I mean, I know if I was furloughed here recently, I'd want to get back to work right away. Why do they think it's going to be so high?
First of all, I think any estimate, whether it's a government estimate or a private economist, take it with a grain of salt. No one knows. We haven't been through this since the Spanish flu in over a century. So how the economy comes back, I think, is a big uncertainty with a lot of range in forecasts. Having said that, why will we not snap back over the next 18 months to that 4% level? Is the reality is some jobs won't come back. Or especially in the next 20 months. And so you're seeing certain industries that are going to have difficulty coming back. They may not have the capital to withstand the downturn. And so some of those jobs are likely to be lost. So, I wouldn't rely necessarily on estimates, but you do see the risk that some restaurants won't make it back, for example. Beyond consumption, there's another economic issue that's received a lot of press over the last few weeks, and that's what's going on with the oil sector. And so what this chart shows is the international petroleum supply and demand. There are several factors that have led to a huge oversupply in oil. First of all, the coronavirus. So the impact on demand for oil is significant, with a lot less traffic in autos and especially within airlines. Second of all, OPEC and Russia failed to reach a deal earlier this year, and at the beginning of the year was increasing supply within the marketplace. The last reason I give for the oversupply is just how the energy market works. So a lot of companies sell on a forward basis, and so are still receiving, above $55, $60 off per oil for their long-term contracts, whereas the short-term spot price of oil is closer to the $24 level per barrel today. What you're now seeing, though, is a more aggressive consumption or a demand production response. And so you're seeing significant cuts in capital expenditures, investment spending from energy companies. So rigs are down some 30 to 40% in the U.S., and most companies in the energy sector are starting to manage for cash. If you look at it from an economic perspective, there is a positive. So consumers at the gas station are certainly spending less than they previously did. But at sub $50 in oil per barrel, there are some negativities assigned if it's sustained for a period of time. So you have not only energy and exploration and production companies, you have industrial products, pipelines. So there's a lot of industries impacted by this cutting of investment spending. And so there's a drag, especially in states that are heavy energy producers.
Yeah, the oil market has obviously seen some issues recently. I think the biggest headlines recently have been the fact that oil prices actually went negative for a while last week or the week before. Is that going to be the new normal, or do you think that that's just a temporary issue?
We believe it's a temporary issue. So what you were seeing as supply was still being produced is storage capacity reached at full levels. So there was not a need within the refiners to receive more oil, and investors got concerned about where would they deliver the oils that they had been contracted to deliver. Although it's possible that it happens again when you see contracts expire here in May or June, in general, we think that's a very temporary solution. With $24 of oil, that's well below the $45 to $50 barrel for exploration and production here in the U.S., and we expect prices to trend higher as you see demand return, as well as the supply cuts that you've mentioned.
Do you think we'll see any?
Go ahead.
I'd say, do you think we'll see any substantial risks for bankruptcy in the energy sector, kind of like we saw back in 2015 and 2016?
Yes. So you've already seen a couple of examples of smaller companies declare bankruptcy because their costs are so much higher and the debt costs from that standpoint. So certainly we're seeing stress in the credit markets. The high yield and energy sector, which most companies outside of the major oils qualify there, are trading at very high risk type levels. I think the question is going to be similar to 2015 and 2016 is, will energy companies have an equity infusion from private equity or private debt? And so it's something to continue to monitor because of that economic impact. So certainly stress and the prospect for more bankruptcies is likely. Oil is not the only sector that's experiencing some pressure from an economic standpoint. And so if you look at on a chart here on page 4 for U.S. company earnings, this is the first quarter earnings per share growth for companies in the S&P 500. And you can see at the bottom of the chart, down 16% with about half the companies reporting first quarter earnings. And so you've seen the impact of COVID-19 within the March, in particular impacting. If you look at the EPS by sector, it's a bit of a case of the haves versus the have-nots. So you see certain industries, your more defensive areas like communication services, healthcare, staples, technology, showing positive growth here in the first quarter, but you also have 5 sectors, the have-nots, in the more cyclical areas such as basic materials, industrials, energy, that are seeing quite a bit of negative growth in earnings. The year-to-date returns is the price returns for the sectors for the first 4 months of the year through April 30th, and you see correlations. So company fundamentals do matter, even in this macro uncertain environment. And so in general, your more defensive areas that have seen earnings resilience are doing better than the market, which is down approximately 10%. And some of your hardest hit areas are under, from an earnings standpoint, are also under pressure from price returns.
Well, as an employee of a bank, I'm maybe a little biased, but I'm kind of curious about the financials numbers. 51% drop in earnings doesn't look great, but is there something that we're not getting the whole story there?
So it's an interesting environment for banks and other financial institutions, and why you've seen such an earnings decline is because in aggregate banks, both the major big 4 banks as well as mid-sized banks such as FNBO chose in the first quarter to set aside reserves for future credit losses. So we're not experiencing stress at this point. But there is an expectation that credit provisions will be necessary for both individuals and businesses. More is expected from a loss standpoint as we enter 2021. So it's somewhat unique. You had a number of the major banks that have stopped buying back shares that are preparing for this difficult credit environment that we have yet to experience, but we're setting aside capital for if that were to occur. The price performance reflects concerns about the credit environment, but also with interest rates dropping to zero, that there will be pressures on financial institutions in terms of what they can earn on a margin basis. Even with the stock market down around 10%, I think that actually hides the volatility that we've seen in the first 4 months of the year. So the next chart shows index performance in different time frames for the S&P 500, which would be U.S. large caps, the Russell 2000, which would be U.S. small caps, and then EPA, Europe, Australia, Far East, which would represent international developed markets. And after an early start to the year that was flat to slightly positive, what we experienced from February 19th to March 23rd is anywhere around a 33 to a 41% type market correction, depending on which of those 3 asset classes that you're looking for. So this is fairly close to what you typically see in a recessionary environment and occurred in a 23-day period. Subsequent to March 23rd through the end of April, we've seen a strong rebound with each of those areas being up anywhere from 21 to 31%. So a strong recovery after that sharp sell-off. And where that leaves us year to date, we already talked about U.S. large caps being down around 10%. Small caps, the Russell 2000 is down 21% year to date, and Europe, Australia Far East, or EPA, is down around 19%. And if you look at why, in general, the small cap area as well as international markets are viewed as more economically sensitive in terms of the companies that make up those respective indices. So within small caps, you see more exposure to financials and discretionary, so areas of the economy and market that have been hit the hardest. And similarly, in international, you have higher exposure to financials and energy. So technology and communication services is more representative in the U.S. large caps and have held up quite a bit better.
When you look at the rebound that we've seen, it's certainly been a lot nicer to see that than the decline we saw back in March. But is this legitimate? Can we expect to see further increases, or do we need to keep an eye on other things in the amount of volatility we've seen so far?
Well, we on the investment team always keep an eye on things, so especially during the middle of the night, apparently, here over the last few months. But I would say there's three reasons for the rebound, and we'll talk maybe a little bit later about the sustainability of it. First has been the government response, Federal Reserve and federal government. Second of all, there has been some positive news flow within COVID-19 in terms of the caseloads and social distancing working out, the fatalities starting to decrease as we see more testing going on. And so there has been, some positives that we're past the peak from the virus. And then lastly, I'd like to remind people that the stock market anticipates or looks forward 5 to 6 months on average. And so the stock market's really not reacting to the negative current news flow on the economy, but it's also looking at, well, what does the recovery look like in the second half of the year? And so there is some optimism as we start to reopen the economy that we'll be in a better situation, and earnings of companies will reflect that. If you look at the Federal Reserve, I want to spend a little bit more time on what's going on within the government response. And this chart shows the Fed's balance sheets. The scale is in millions, which means, in essence, that each equates to trillions of dollars. So the Fed balance sheet from around 2015 through 2018 was running about $4.5 trillion. And what that means is on the Federal Reserve's balance sheet is primarily back then was treasuries and mortgage-backed securities as they went through a variety of quantitative easing programs earlier in the prior decade. They started to shrink the balance sheet, as they know, in 2018 when they were increasing interest rates and drawing down to less than $4 trillion. But as you can see from this chart, we've seen a huge spike, especially over the last 6 weeks, to the $6.5+ trillion level. And so the Federal Reserve, in addition to cutting interest rates to zero in March, they also implemented programs to buy treasuries, mortgage-backed securities. Again, they've also looked at buying investment-grade corporate bonds and the so-called fallen angels, or investment-grade corporate bonds that have fallen into the high-yield category. So there was a lot of issues with credit. Short-term credit facilities had tightened or had exploded out within commercial paper, and the Fed has provided a lot of liquidity and backstop through a variety of programs associated with buying corporate bonds, mortgage-backed securities, asset-backed securities, treasuries, but they've also implemented the Main Street lending facility. And so the Federal Reserve's response, has been very aggressive. The old adage in the market is "don't fight the Fed," and right now that has been coming true in terms of the amount of liquidity that the Federal Reserve is, working on for risk-based assets. The federal government has also been aggressive, and this is the 4 acts that have been approved into law from March 6th to the latest one on April 21st. In the past, we did talk about the CARES Act and prior calls, so $2.2 trillion in a variety of different areas, which represents around 10% of GDP. The latest so-called 3.5 phase was to replenish the Paycheck Protection Program, which ran out of dollars within a couple of weeks, but also targeting small businesses and public health and hospitals in particular. This $484 billion package approved a couple of weeks ago is around 2% of GDP. I think a couple of points to make. So in aggregate, we're talking about almost $3 trillion, 13% of GDP, and if you compare it to the financial crisis, that is approximately double what we've seen. It's also unprecedented in this that all this occurred before the recession hit. So clearly with the economy shutting down, Congress and the White House knew the impact and was looking to cushion the economic downturn. Is there more to come? I think there's discussions about another $1 trillion currently, although there's not as much widespread agreement in Congress in terms of what that should entail. Our thought is there's likely more to come in that a lot of the stimulus that's been provided has an end date that's somewhere between 2 to 3 months, whether it's unemployment insurance, the PPP program that they mentioned was really to get us through this closed period of time. And depending on how the economy recovers in the second half, we'll see if there's more stimulus needed or will be approved and enacted into law to help continue to cushion the downturn. This is having an impact, as you expect, and one of the questions we have been receiving is about the deficits and overall debt levels. Once again, the CBO estimates the deficit this year for the federal government will be $3.7 trillion and an additional $2.1 trillion in 2021. These are extremely large numbers. The deficit this year is almost 18% of GDP. I think the concern that you're reading about is, and our view would coincide with that, is this is the time frame to run a deficit, but can you manage that deficit when the economy returns to some form of new normal? So the escalating debt is a concern. Trading Economics estimates that the end of this year will be 110% of GDP, which may surpass the all-time high in 1946. So long-term, we do have concerns that how to get the deficits under control once you get back to economic growth from that perspective.
And if you look at the federal government, they can sustain deficits like this for a while, but states don't have that luxury. What are you seeing in the impact of the municipal market and how state balance sheets are being impacted?
Yeah, that's a more difficult issue. So municipal bonds have been under somewhat pressure. They were rallying back as part of some of the municipality credit facilities the Federal Reserve had put in. And then comments about potential for state bankruptcies and not wanting to support banks have led to some additional concerns. Did want to put it in perspective. So the overall bond market, municipals are about 9% of the bond market. There is stress there. But if you look at how states and other counties, cities have managed through crises and recessions, it typically has been done through expense reductions, although they're clearly maybe looking for how to increase revenues as well in this time frame. So we don't expect to see state bankruptcies, not allowed by law, and there would be, this would be a Supreme Court issue if you tried to change that. So we don't expect that. What we see is instead of defaults within municipalities, is there an economic impact as layoffs occur, whether you're in education, essential services such as police and fire. So states are certainly going to be tightening and be required to, because 49 of the 50 states actually have a balanced from a revenue and expense standpoint. So a balanced budget is a part of their requirement. And so there is going to be an economic impact. I think it is likely that the federal government will also continue to support, states so they understand the economic ramifications from needing to run a balanced budget. Let's switch and talk a little bit about our investment strategy and what we're implementing in portfolios. Here at FNBO, we work with very conservative to aggressive investors. We think it's important to set that long-term asset allocation. At times with us, we have financial planning capabilities, and so that's a part of our approach, and we found clients seeing comfort within their financial plan, which anticipates environments such as what we've experienced over the last few months. For purposes of the conversation today, we've set it a moderate objective, so kind of a middle of the road. The asset class ranges for equities is 40 to 70%, fixed income is 20 to 50%, alternatives 0 to 20%, and cash 0 to 10%. And what we provided for you is a snapshot of what those portfolios look like in the end of February, March, and April. And I'll just highlight that the equities were right around that 55% midpoint of the range, dipped in March primarily because of the weakness within the stock market, and then is rebounded to almost the 55% level here in April. And so it just shows you that consistency or the benefits from having exposure to all those asset classes, that the numbers moved around, but diversification and the benefits from staying invested paid off. In terms of our trades and what we implemented on a broad scale basis, we did trim fixed income was the primary area. So that part of the market has gotten expensive as yields have dropped. And instead of adding to equities, we chose to add to our alternatives category. We used a hedged equity product that provides some participation in the stock market, but what we really like is it also has some downside protection. And so we like that risk-adjusted return standpoint. That fund through the first 4 months is actually marginally positive from that standpoint. So not a lot of tactical changes to what we're implementing in client portfolios. What you have seen underneath the hood, I like to talk about it within our individual security portfolios, is a lot of activity in fixed income, from selling treasuries to buying corporate bonds and other credit-oriented securities, taking advantage of when spreads were widening out there in the March timeframe. And within equities, our teams have been more active in terms of buying quality companies at a discount and better positioning our portfolios, not only for now, but in terms of how we're going to come out of this economic downturn.
Yeah, I think we've all got a little Monday morning quarterback in us. We can look back and say, boy, we should have bought some stocks, a month ago when we were at the bottom. But obviously, we don't stress market timing as a viable investment strategy. What do we look at right now? Do you want to talk a little bit about why we've been cautious still in the market? Do we still see an opportunity in stocks?
Yeah, unfortunately, my crystal ball was broken in late March. Just joking there. So why we're a little bit cautious, I would say, is just back in late March when we're seeing most of the volatility, is just the severity of the downturn. And so this is something that I mentioned that hasn't occurred in a century plus, having a dramatic impact on company earnings, even with only March showing up from a forecasting standpoint. And so part of our tactical asset allocation decision is, economic growth, company earnings, and valuations. And we saw a lot of uncertainty. So we chose to stay invested, but more be focused on it's time to protect portfolios. We're coming off such a great 2019 and made the decision not to be aggressive. Short term, and we'll talk about that in a minute, we still have some concerns in terms of that outlook. But we do see it as a long-term opportunity, and we'll also talk about the opportunities in optimism on a long-term basis so that we will get through this. So the way I look at it is volatility is likely to continue. You go through periods of fear and euphoria in a recession in terms of how you're coming out of it and what it means for company fundamentals. And so we think there will continue to be opportunities, but long-term, the market has always returned to all-time highs. It may take a few years, but from a long-term perspective, that's where we advise on staying invested. I'm going to talk a little bit about the review company estimates. I do want to talk about that. That was a piece of our decision-making process and continues to be. And what this chart shows is the U.S. Earnings per share or EPS growth expectations for the S&P 500 for each of the quarters in 2020. I'll just highlight what's occurred in the second quarter to start with. So at the beginning of the year, the market was expecting 5.34% growth in earnings for the second quarter. And you can see each month it had deteriorated, and by April 1st, the market was expecting a negative 10%, so an earnings contraction for this quarter. And as of April 29th, the market was expecting a 34% contraction in earnings. And this is pretty consistent, regardless of which quarter you look at, in terms of how much earnings expectations have been reduced. And these numbers are more than that 10% decline in the S&P 500. So actually, on an earnings basis, the stock market is now much more expensive than it was in February of this year. We think the key, though, is not how negative the current environment is, going back to my earlier comments that the stock market looks ahead. We think the key is what do the earnings look like in the second half? And so I'm referring to what we bracketed, which is the latest expectations were down 20% year-on-year earnings per share growth in the third quarter and down 12% in the fourth quarter. Do we start to see a stabilization in terms of the earnings outlook in the second half of the year? Do you start to see these numbers improve as we get more information in terms of the economic recovery as states reopen? And so we here believe that earnings matter this year. There's some talk that you should just write off 2020 and just focus on 2021, but we continue to be focused on what is the recovery in the second half of the year, in addition to looking at 2021 earnings. If you look at that, I alluded to this a little bit earlier, so it's earnings as part of it, but what is the valuation and the opportunities that we see? And this is the long-term opportunity on why we think stocks will look better. And what this chart shows is how does the S&P 500 dividend yield compare to the 10-year Treasury yield, which was 0.72% earlier today. And what you can see is stocks are now yielding quite a bit more than bonds. Now, there is some talk that dividends will be cut. It will probably be isolated to a few sectors that are experiencing the most pressure, such as energy, consumer discretionary, industrials, perhaps some financials. But in general, most estimates are, even if earnings are reduced by 15 to 20%, you're still talking about dividend yields above 2% for the stock market. We also look at it on an earnings basis. So similar story that stocks are relatively attractive to treasuries, in part due to just how low treasury yields are doing. So this is part of our thought processes. People will be searching for income. They can get it more in the stock market than the bond market, and long-term investors will be rewarded for holding on to equities. I'd like to transition now to our final slide, which is the opportunities and risk. And then before I do, remind you to keep sending in your questions through the chat function, where we have left and allocated some time for that. I'll just highlight a few of the concerns on the right side of the chart that we're watching or focused on. First of all is the consumer behavior in the post-COVID world. And by that I mean, if you look at, there's a lot of discussion on, when states should reopen, how do they reopen, how do they do it, and manage it and the impact on the virus and that sort of thing. I think the reality is it's consumers that determine how the economy reopens. So if there are restaurants that are open here in the next month, depending on the state that you live in, are you willing to go to restaurants? Are you back to normal from a spending answer? If the answer is, 90% of what we do is back to normal, maybe we don't get on a plane or go to a hotel, but outside that, we're confident and we're not fearful, then you can see, a better economic environment. But if the answer is, and some of the surveys, at least with certain industries, say it's less than half the people that even if they have that capability, that they would return to normal, that's another issue in terms of how the second half recovery may not be as strong as anticipated. Along with that is the fear regarding the virus. So a lot of talk about the fall resurgence in COVID-19. That will have an impact on consumers again, confidence and fear, and ultimately the economic recovery that we see. The last one that we haven't talked about in the concerns is geopolitical risk. Certainly the discussions, if you'd call them that, with China in terms of what's going on in terms of the China-U.S. relations, but more than in discussion about the virus and the economic ramifications, there's other areas of the world, whether it's North Korea, Venezuela, Russia, Iran. And so when you see the extent of the global downturn and a recessionary is, do some of these hot spots filter over and cause problems for global economy and companies? But we wanted to end on a little bit more of a positive note. So we're always worrying, as I mentioned, on the investment team. Can the economy restart quickly? There is a lot of pent-up demand. And so certain industries will come back quicker than others. But I think there is an interest for all of us in getting out of the homes, seeing people, and experiencing some of those consumer-oriented activities that we've gotten used to. I also think human ingenuity, the healthcare response. So there has been some positives from Gilead on a drug called remdesivir. There's also been some news flow on other antiviral drugs. And so we are finding ways to better combat the coronavirus, better treat, which should lower the overall fatality risk. Another key is all the efforts going on within vaccines. They've characterized it as Operation Warp Speed. So already we're down to and have identified 14 vaccines. And in the next 2 weeks, we're narrowing that further to 6 to 8 weeks of the most promising vaccines for future testing, which will ultimately be likely about 3 to 4 vaccines. So, in essence, don't count. We're spending millions of dollars from both how to treat the virus, but as well, hopefully to have a vaccine as we enter 2021. The third point that I wanted to bring up here is the human ingenuity with adaptation. So I think the U.S. is particularly strong at finding better, more efficient ways to do business. You've seen that within restaurants and how quickly they've adopted to curbside pickup. And so, I always like to say, don't underestimate the power of the economy and us as strengths in terms of how we respond to crisis and how we find better and more productive ways to do business. The last point I want to make is in regards to the bottom point, the stable financial system. So compared to the financial crisis in 2009, what you typically see following a financial crisis is very slow recoveries because banks are in the process of recapitalizing and they don't have the capital to sustain faster economic growth. So what we experienced over the last 10 years is typical following a financial crisis and very similar to when other countries have gone through those type of events. This is different. Certainly there is stress, as we mentioned, on the financial institutions, but the sector as all has recapitalized it and is in better position to continue to support the economy. Here at FNBO, our focus is to help our customers get through this crisis. We are proud that the bank has come together and how we are doing within the community. So our response to the PPP program and support of businesses throughout the bank footprint. We have the capital and revenues. They're at the highest levels ever to make it through this recession and come out stronger. And then lastly, the senior management team, historically, as we've gone through recessions, we've used crises to improve and transform the company, and that's what the senior management team and the rest of all of us as well are working on, how to come out of this better and stronger and help support growth within our communities. So with that very short FNBO and reassurance, hopefully, that we're in a position to continue to work with our customers on the banking side, I thought I'd stop there and entertain any more questions than we've already gotten.
Yeah, thanks, Kurt. That's a fantastic overview of what's happening, and I think we have quite a few questions here. Just a reminder for the participants on the phone, please feel free to send in more questions. We've definitely allocated some time to answer more questions if you have them. I know we covered quite a bit here, so feel free to use that chat function to send in questions. And if you don't have access to the computer or you're just listening on the phone, please feel free to call in to your advisory team, and we'll be happy to follow up with you if you have more questions. So, Kurt, we do have a few questions here. Would you like the softball questions, or will you start with a high-inside fastball?
Start with the high end. I might run out of steam, end of a long day. So let's start with the tough.
Well, there's a couple questions in regards to the upcoming election, which was the topic of choice before March. Wondering if we're thinking about that at all as we think about all the other issues going on right now, and is that impacting our portfolios at all?
Yeah, we're always thinking about it, and I guess I'll go back to the 2020 outlook that we wrote, that policy matters, not politics, was the theme that we wrote about, and that still holds true today. So when you look at it from a politics standpoint, it's not impacting our asset allocation decisions, in part because some of the policy changes that could come about post-elections, such as increasing taxes, are unlikely to occur. And so the environment that we're in, you're seeing good or bad, high levels of budget deficits likely to continue into 2021 because nobody will want to choke off an economic recovery, assuming that we're in one at that point. And so it's something that we continue to evaluate, but we don't see a lot of policy changes at this point in time. But obviously, we'll continue to watch and evaluate that through the election.
Well, speaking of policy changes, the current policy seems to be issuing a lot of debts and supporting the economy, which clearly has helped. But what's the long-term impact of this debt going to be on inflation?
Yeah, when we look at it, well, we've answered the rising debt question here. I've always said, well, we're 15 years from it becoming a problem here in the U.S., and that's just because our debt to GDP was much lower than Europe and Japan, China, so other major countries. So even though it felt like it was out of control and escalating, it was still at manageable levels. What the extent of the budget deficits have occurred has brought that forward, assuming we don't get it under control starting in 2022 and beyond. And so just those high levels of debts, and what it does is it lowers your economic growth, so more of your payments go for interest repayments as compared to economics producing, and then it does have an inflation potential from that standpoint. So I would say, to answer your inflation question, short term, it's more deflation. So you're seeing that in commodity prices, rental prices for apartments, and so certainly there's not an inflation concern. In fact, the opposite is occurring. But what could happen is, if you get the economic recovery and you're still spending $2 trillion in a budget deficit, could that become inflationary? So, what I would say is the more you run a deficit and continue to run, the more that risk could occur once the economy recovers.
Yeah, and I typically say I'd like to see some inflation. We haven't really seen it in decades, except for small oil shocks. So I think the Fed would welcome some inflation at this point in time.
Yeah, I agree. 2% is their soft target, and there's a reason why it's not a 0% is their target. So a little bit of inflation is good from an investment perspective.
There's a few questions in regard to getting copies of the slides. Yes, we will be distributing these, the slide deck to our advisors, and they will be able to send those to you after this call. So we'll definitely send those out to you. So one of the other prevailing questions here is in regards to equity valuations, and I know you talked a little bit about this, but you know, we clearly see some volatility ahead of us. How should we be thinking about investing in stocks as we move forward, especially if we have clients with cash on the sidelines right now?
Yeah, the way I always look at the equity part, or that part of your bucket or your pool of assets, is that's your 5 to 10 year money. And so, you know, making sure that you have the appropriate asset allocation that you can withstand this downturn, you know, is critical during this time frame, because you don't have any intention of using it for the next 5 to 10 years. And so that hasn't changed. So looking at equities, it's a speculation that the market's going to be higher in a month or lower in a month. You know, that's just not, a great usage of your time from that perspective. What I would say from a cash standpoint is, and we have had contributions to accounts from some of our clients, is now more than ever is average into the market. So it's something that we like to do in good times and take advantage of this. So we don't think the stock market's going to continue to rocket to all-time highs in the next few months. And go through those periods of volatilities as there's disappointments and then euphoria surrounding the economic recovery. And so what we like to do on the investment team is buy on those 3% down days. So it's an appropriate time to work with your advisor team. Is it over the next couple months? Is it over the next 6 months? Is determining if you have cash and you want to put it to work and you have that long-term framework from an equity perspective. So valuations, the other part of the question, they are high, but that's on, pretty depressed earnings. And so if you look out a couple of years and the economy returns to growth and unemployment comes down, earnings come back, you can grow into those valuations, assuming the recovery takes hold.
Now, if we flip to the bond side of the portfolio, obviously, with rates so low right now, we have a lot of clients who rely on their portfolio for income, cash flow, either retirees or people who need to supplement their income. How should we be looking at portfolios with rates down now, and how can we plan for the future with that?
Yeah, for most of the portfolios, fixed income is still appropriate. It's provided that capital preservation during this downturn, and will again. I would also, caution, we've talked about how low bond yields are for treasuries, and yields and interest rates are low forever. But certainly, corporate bonds, investment-grade corporate bonds, for example, are trading at above average spreads than what they typically do. Municipal bonds, as we've talked about, has been under pressure from some of the news flow, on states in particular. And so there are opportunities within fixed income. So we own diversified fixed income holdings. We don't own just treasuries for IRA accounts. We don't own just municipal bonds typically for, tax-exempt accounts. And so this is where diversification comes in to generate some of that additional income than we're looking for. We're also looking at, other opportunities to generate income within the stock market, within alternatives, and that sort of thing. But I think to be conservative, your portfolio is unlikely to generate the same level of income that it has, over the last, 20 or 30 years when interest rates were higher. And so that should be part of your financial planning in terms of what's the appropriate level of distributions. Also, at times, we're relying on the appreciation in the portfolio, so not just what stock dividends and interest rates from fixed incomes generate from a return standpoint. So you look at it as a pool of assets. What's the income? What do you need and make decisions in terms of what's reasonable.
All right, I think we addressed all the questions in the chat. Thanks very much, Kurt, for taking time, and thanks to all of our clients for attending here. I know it's obviously a concerning time with the volatility we've seen and all the discussions out in the news these days, but be aware we're here working. We are socially distancing, so we're all working from home right now, but we are definitely taking care of your investments and watching out for your financial plan to make sure it's still intact. So if you do have more questions or there's anything you want to follow up on that wasn't covered in the discussion, please feel free to reach out to your advisory team. They'll be happy to have more discussions and get more commentary on what we're thinking these days. And with that, I'd like to say just have a great week, and we'll talk again soon. We'll likely have another one of these down the road as the market continues to evolve, so please look forward to that. And again, thank you for working with us. We appreciate your business, and we'll talk again soon. Have a great day.